Hey, it's Tom here and welcome back to the channel. Now, one of the biggest treasure troves of investment knowledge that I am very often kind of pushing people towards to kind of check out are the Warren Buffett or Berkshire Hathaway annual shareholder letters. Buffett has been writing these for decades now through his company, Berkshire Hathaway, and even pre-Berkshire Hathaway, he was writing annual shareholder letters every year to the investors in the early Buffett partnerships. And in each of those letters, there are little nuggets of wisdom and things we can take away and learn from the master, from Warren Buffett. And this year is no exception. So just a couple of days ago, Warren Buffett released his 2021 annual report, which comes out in February 2022, and that included his latest shareholder letter. So I will leave a link in the description if you want to check out the full letter. But in this particular video, I want to go through some of my own personal highlights from the letter and some of the things that Warren Buffett had to say, both about investing in general and also about some of the things going on at Berkshire Hathaway. And although we don't have time to cover it today, I will also leave a second link down in the description, which will actually take you to the full Berkshire Hathaway annual report. And part of that annual report is actually, as far as I'm aware, the first ever letter from Greg Abel. Now, if you're not familiar already, Greg Abel basically heads up all non-insurance businesses at Berkshire. He is very heavily involved at the very large subsidiary that is Berkshire Hathaway Energy. And Charlie Munger kind of let it slip last year at the Berkshire Hathaway annual meeting that Greg is very likely to be the future CEO at Berkshire once kind of Warren and Charlie move on. So really interesting to get some thoughts from Greg Abel. It was very focused on some of Berkshire's kind of sustainability initiatives, particularly in the Berkshire Energy businesses. So yeah, I'll leave a second link in the description if you want to check that one out as well. So it's always an exciting time when the new annual letter hits the Berkshire Hathaway website from Warren Buffett, and I'm excited to share my highlights in this video. So if you do enjoy it, please hit like and also subscribe if you are new here. But without further ado, let's get straight into my highlights from Warren Buffett's 2022 annual letter. Okay, so for the longest time now, Warren Buffett's made a tradition of starting out his annual letter basically just with a table of Berkshire performance. Now, previously, he used to display the change in book value at Berkshire versus the S&P 500. In more recent years, he's changed that metric slightly, so we now get to see the per share market value of Berkshire and how much that changes year to year. And again, you can see what the performance of the S&P 500, including dividends, has done in that same period of time. So this basically allows us to see that if you're a Berkshire shareholder, over a given period, you can kind of see how you'd performed generally and how you'd performed against the S&P 500. And this shows pretty clearly why Warren Buffett is largely regarded as the greatest investor of all time. The track record runs from 1965 through to 2021. He's got a compounded annual gain of 20.1% per year versus 10.5% for the S&P 500. And, 20% in 1 year versus 10% in the S&P 500 in a single year, that's a big outperformance. But compound that difference from 1965 through to the end of 2021 and the numbers just get ridiculous. So if you had invested in the S&P 500 and reinvested your dividends every single year, you would now be up about 30,209% versus Berkshire, which is up 3,641,613%. Now, before Buffett got into kind of his key lessons that he wanted to get across in this particular shareholder letter, he kind of started out with his mission and, how he thinks about Berkshire shareholders and what he kind of does on a day-to-day basis. So I'll just read a short section from the very start of the Berkshire letter here. So he said, "To the shareholders of Berkshire Hathaway Inc. Charlie Munger, my longtime partner, and I have the job of managing a portion of your savings. We are honoured by your trust. Our position carries with it the responsibility to report to you what we would like to know if we were the absentee owner and you were the manager. We enjoy communicating directly with you through this annual letter and through the annual meeting as well. Our policy is to treat all shareholders equally, therefore we do not hold discussions with analysts nor large institutions. Whenever possible, also we release important communications on Saturday mornings in order to maximize the time for shareholders and the media to absorb the news before markets open on Monday." Now that initial kind of intro from Buffett really describes how he's played the game forever. He is not particularly interested in, beating a quarterly earnings expectation or having Berkshire portrayed really well on CNBC immediately, or having aggressive moves in stock price in the short term. He really wants to treat all of his shareholders as partners, and although there is obviously going to be some shareholders that are moving in and out in the short term in any stock, and Berkshire's no exception, Berkshire does really have an overwhelming kind of proportion of their shareholder base that are there for the very long term. And he treats them just as if they were partners in kind of a private business. And he releases all this information on a Saturday morning so that, the average everyday person who's not a hedge fund manager or something has a bit of time to digest the information that's actually coming to them. Now, the audience for this Berkshire Hathaway annual letter, although it's addressed to shareholders of Berkshire Hathaway, this letter is read very widely. And so Warren Buffett kind of goes out of his way here to basically describe their general investment strategy, and he also presents kind of some surprising facts. So a couple of my highlights from that, he says in a section called What You Own in this letter, Berkshire owns a wide variety of businesses, some in their entirety, some only in part. The second group largely consists of marketable common stocks of major American companies. Additionally, we own a few non-US equities and participate in several joint ventures or other collaborative activities. Whatever our form of ownership, our goal is to have meaningful investments in businesses with both durable economic advantages and a first-class CEO. Please note particularly that we own stocks based upon our expectations about their long-term business performance and not because we view them as vehicles for timely market moves. That point is crucial. Charlie and I are not stock pickers, we are business pickers. Now, I'm sure many of you have heard Buffett say something like that a million times over, and hopefully it's kind of nicely drilled into your head that we're looking to buy ownership in great businesses as opposed to speculate in markets, but there is a lot of kind of broad speculation across several markets going on at the moment, so always good to drive that one home. Now, in terms of a couple of kind of surprising facts, and Buffett did actually share a couple of these last year, there is a few that he says, these are a few facts about your company that often surprise even seasoned investors. Many people perceive Berkshire as a large and somewhat strange collection of financial assets. In truth, Berkshire owns and operates more US-based infrastructure assets classified on our balance sheet as property, plant, and equipment than are owned and operated by any other American corporation. That supremacy has never been our goal. It has, however, become a fact. At year-end, those domestic infrastructure assets were carried on Berkshire's balance sheet at $158 billion. That number increased last year and will continue to increase. Berkshire always will be building. He also goes on to say, every year your company makes substantial federal income tax payments. In 2021, for example, we paid $3.3 billion, while the US Treasury reported total corporate income tax receipts of $402 billion. Additionally, Berkshire pays substantial state and foreign taxes. I gave it the office as an unassailable assertion when made by Berkshire shareholders. Now, of course, Buffett has been quite outspoken about tax over time and how he thinks that very, very wealthy individuals like himself, as a multi-billionaire, should be taxed more heavily. But I think there is kind of a misunderstanding around how much tax very wealthy individuals pay. They pay a heck of a lot of tax through, corporate enterprises such as Berkshire. So again, still kind of a controversial subject, but an interesting one to note nonetheless. Now, the next part of the letter here from Warren Buffett is what he describes as our four giants. These are kind of the key business segments of Berkshire that really move the needle the most. Now, Berkshire is a very diversified enterprise. They own a long list of different stocks. They own a very long list of companies outright, but the overall kind of amount of capital invested through Berkshire is really concentrated in only a handful of operating businesses and publicly traded companies. So these are the big four that Buffett describes that will really move the needle for Berkshire. So he says, through Berkshire, our shareholders own many dozens of businesses. Some of these in turn have a collection of subsidiaries of their own. For example, Marmon has more than 100 individual business operations ranging from the leasing of railroad cars to the manufacture of medical devices. Nevertheless, operations of our big four companies account for a very large chunk of Berkshire's value. Leading this list is our cluster of insurers. Berkshire effectively owns 100% of this group, whose massive float value we earlier described. The invested assets of these insurers are further enlarged by the extraordinary amount of capital we invest to back up their promises. The insurance business is made to order for Berkshire, the product will never be obsolete, and the sales volume will generally increase with both economic growth and inflation. Also, integrity and capital will forever be important. Our company can and will behave well. There are, of course, other insurers with excellent business models and prospects. Replication of Berkshire's operation, however, would be almost impossible. So it's pretty well known at this point that a big core of Berkshire's business is insurance. They own a range of different insurance companies like Geico, National Indemnity, and kind of the list goes on for quite a long time. And that has kind of a couple of advantages at Berkshire. One of the really big ones being float. Basically, when you pay, an insurance premium for insuring your car through Geico or whatever it might be, that's kind of money that you typically pay up front. It's very sticky. That money gets paid back out to some people that make claims and so on. But basically, Berkshire gets to invest that money that you paid them up front in stocks or in bonds or whatever they really decide to invest it in. And it has really been fuel on the fire for growing the equity of Berkshire over time. It means that they can invest other people's money for basically less than nothing. It's kind of like getting a interest-free loan, or even getting paid to take that money if they've got a profitable insurance operation. And it's been a really beneficial kind of approach for Berkshire over time. Now, the second giant in the Berkshire business that Buffett describes is Apple. So he says, Apple, our runner-up giant as measured by its year-end market value, is a different sort of holding. Here, our ownership is a mere 5.55%, up from 5.39% a year earlier. That increase sounds like small potatoes, but consider that each 0.1% of Apple's 2021 earnings amounted to $100 million. We spent no Berkshire funds to gain our accretion. Apple's repurchases did the job. It's important to understand that only dividends from Apple are counted in the generally accepted accounting principles earnings Berkshire reports, and last year Apple paid us $785 million of those. Yet our share of Apple's earnings amounted to a staggering $5.6 billion. Much of what the company retained was used to repurchase Apple shares, an act we applaud. Tim Cook, Apple's brilliant CEO, quite properly regards users of Apple products as his first love, but all of his other constituencies benefit from Tim's managerial touch as well. Now, the Apple position is one that we will know pretty well if you've followed Berkshire and Warren Buffett for the last few years. He acquired most of that Apple stake in around 2016, and it's done extremely well. And they're kind of running the Coca-Cola playbook from when Buffett bought into Coca-Cola in the 1980s. He bought a reasonable stake in the company. I think with Coke it was around 7%. Don't quote me on that, but I think it was something like 7%. And over time, the proportional ownership has increased closer to 9% or so from these repurchases. So similar thing happening at Apple, and he clearly kind of loves the brand and the management. And that business generates a lot of cash flow, which Buffett also happens to like. So moving on now to his third giant. So he says, BNSF, which stands for Burlington Northern Santa Fe, our third giant continues to be the number one artery of American commerce, which makes it an indispensable asset for America as well as for Berkshire. If the many essential products BNSF carries were instead hauled by a truck, America's carbon emissions would soar. Your railroad had record earnings of $6 billion in 2021. Here, it should be noted, we are talking about the old-fashioned sort of earnings that we favour, a figure calculated after interest, tax, depreciation, amortization, and all forms of compensation. Our definition suggests a warning. Deceptive adjustments to earnings, to use a polite description, have become both more frequent and more fanciful as stocks have risen. Speaking less politely, I would say that bull markets breed bloviated bull. BNSF trains travelled 143 million miles last year and carried 535 million tons of cargo. Both accomplishments far exceed those of any other American carrier. You should be proud of your railroad. Now, for a long time, particularly Charlie Munger at Berkshire has called, EBITDA and some of these metrics used by particular companies BS profit, and it's kind of cool to to see Buffett taking a bit of a stab at that as well. So in terms of old-fashioned earnings, the railroad produced $6 billion in 2021. It's a monster business at Berkshire. So the final giant that Buffett describes is Berkshire Hathaway Energy, described in the letter as BHE. So this is the business that is largely managed by Greg Abel, and Berkshire has, I believe, about a 91% interest in Berkshire Energy. So they don't actually own it entirely, but they own a huge chunk of it, and hence it has the name Berkshire Hathaway Energy. So Berkshire Hathaway Energy, our final giant, earned a record $4 billion in 2021. That's up more than 30-fold from the $122 million earned in 2000, the year that Berkshire first purchased a BHE stake. Now Berkshire owns 91.1% of the company. Berkshire Hathaway Energy's record for societal accomplishment is as remarkable as its financial performance. The company had no wind or solar generation in 2000. It was then regarded simply as a relatively new and minor participant in the huge electric utility industry. Subsequently, under David Sokol's and Greg Abel's leadership, Berkshire Hathaway Energy has become a utility powerhouse, no groaning please, and a leading force in wind, solar, and transmission throughout much of the US. The letter goes on to then direct you to the letter from Greg Abel, which will be linked down in the description, so definitely check that one out. Berkshire Hathaway Energy has been faithfully detailing its plans of performance in renewables and transmissions every year since 2007. And again, to further review this information, visit Berkshire Hathaway Energy's website at brkenergy.com. There you will see that the company has making climate-conscious moves that soak up all of its earnings. More opportunities lie ahead. Berkshire Hathaway Energy has the management, the experience, the capital, and the appetite for huge power projects that our country needs. Okay, now there are two final highlights from the Berkshire letter that I want to mention here, and both of them are ones that kind of get reported in financial media and financial news all the time. One is the massive position that Berkshire Hathaway currently has just sitting in cash, or more specifically, they have it in like short-term treasury bills, but effectively they're cash alternatives, and that investment is, those cash kind of investments are really not earning any sort of return, and people are kind of saying in financial media particularly, is Buffett waiting for a crash or something like that. So he does kind of give us some commentary on that particular subject, and he also talks about share repurchases and some of the buybacks that they have been doing at Berkshire. We've already had the Apple example where the per share ownership in the overall Apple kind of company has increased from Berkshire not outlaying a cent because of the buybacks that Apple and Tim Cook have been doing, and Berkshire have been doing a similar thing with their own company. So he gives us kind of his views on how he thinks about repurchases as well. So firstly, this is what Buffett had to say about the $144 billion that Berkshire Hathaway currently has in short-term treasury bills, which interestingly he says is anywhere between 0.5% and 1% of all of the publicly held national debt. So they are a pretty big player on the bond market right now, and this is what he had to say about that enormous kind of sum of money that's in short-term treasuries. So he said, but 144 billion. That imposing sum, I assure you, is not some deranged expression of patriotism, and what he's referring to there is something he mentioned in kind of the previous paragraph about, supporting the country by owning all this publicly held debt. So he said, it's not some deranged expression of patriotism, nor have Charlie and I lost our overwhelming preference for business ownership. Indeed, I first manifested my enthusiasm for that 80 years ago on March 11th, 1942, when I purchased 3 shares of City Services preferred stock. Their cost was $114.75 and required all of my savings. The Dow Jones Industrial Average that day closed at 99, a fact that would scream to you, never bet against America. I might put up a quick thing on the screen here just to show you where the Dow sits today. It's definitely higher than 99, so it's kind of a huge amount. So interesting kind of reference point there. So Buffett goes on to say that after my initial plunge, I always kept at least 80% of my net worth in equities. My favoured status throughout that period was 100% and still is. Berkshire's current 80% or so position in businesses is a consequence of my failure to find entire companies or small portions thereof, that is marketable stocks, which meet our criteria for long-term holding. Charlie and I have endured similar cash-heavy positions from time to time in the past. These periods are never pleasant, they are also never permanent, and fortunately we have had a mildly attractive alternative during 2020 and 2021 for deploying capital. Read on. And that's when he kind of goes on to talk about these share repurchases. So I think a couple of things to note there. Firstly, the 144 billion in short-term treasuries, it's a massive number, but relative to the overall assets that Berkshire has, he views himself still as about 80% invested in equities or about 20% cash. That's kind of how he's looking at it. And it's really not a consequence of kind of timing markets or anything. It's really a consequence of Berkshire continues to generate a lot of cash, and Buffett has kind of failed to find interesting places to deploy said cash. So that's what he had to say about the cash position, and then he went on to talk in quite a bit of length about share repurchases. Firstly, he started out by saying basically his preference for deploying capital is to grow the pie at Berkshire and invest in new businesses and new marketable securities. But then he said our final path to value creation is to repurchase Berkshire shares. Through that simple act, we increase your share of the many controlled and non-controlled businesses Berkshire owns. When the price to value equation is right, this path is the easiest and most certain way for us to increase your wealth. Alongside the accretion of value to continuing shareholders, a couple of other parties gain. Repurchases are modestly beneficial to the seller of the repurchased shares and to society as well. Periodically, as alternative paths become unattractive, repurchases make good sense for Berkshire's owners. During the past 2 years, we repurchased 9% of the shares that were outstanding year-end 2019 for a total cost of $51.7 billion. That expenditure left our continuing shareholders owning about 10% more of all Berkshire's businesses, whether they are wholly owned such as BNSF or Geico, or partly owned such as Coca-Cola or Moody's. I want to underscore that for Berkshire repurchases to make sense, our shares must offer appropriate value. We don't want to overpay for the shares of other companies, and it would be value destroying if we were to overpay when we were buying Berkshire. As of February 23rd, 2022, since year-end, we repurchased additional shares at a cost of $1.2 billion. Our appetite remains large, but will always remain price dependent. It should be noted that Berkshire's buyback opportunities are limited because of its high-class investor base. If our shares were heavily held by short-term speculators, both price volatility and transaction volumes would materially increase. That kind of reshaping would offer us far greater opportunities for creating value by making repurchases. Nevertheless, Charlie and I prefer the owners we have, even though their admirable buy and keep attitudes limit the extent to which long-term shareholders can profit from opportunistic repurchases. Finally, one easily overlooked value calculation specific to Berkshire, as we've discussed, insurance float of the right sort is of great value to us. As it happens, repurchases automatically increase the amount of float per share. That figure has increased during the past 2 years by 25%, going from $79,387 per A share to $99,497, a meaningful gain that, as noted, owes some thanks to repurchases. Now, there are also a couple of other sections to this letter that unfortunately we don't have time for in this video. It talks about a section called A Wonderful Man and a Wonderful Business, where one of the Berkshire managers, Paul Andrews, recently passed away, who was the CEO of TTI, and it talks through kind of the purchase of that business, and it's a really good example of kind of the reputation that Buffett and Berkshire have built up over time and allowing them to purchase great businesses when they're really kind of the last ones left. They're the type of people that won't make it like a leveraged buyout, and they won't try and replace the management, and they really just want to put capital to work and leave the existing management to do their thing. Like Berkshire has like 30 people at headquarters, yet they employ hundreds of thousands of people across all their businesses. So that's a really interesting section to the letter. So I definitely would recommend reading the full letter if you're interested in that. Again, it will be linked down in the description. But those are some of my highlights from what Warren Buffett had to say this year. Some really interesting points around the cash position and share buybacks. I think some of the long-time followers of Berkshire and Buffett will be kind of familiar with this philosophy on some of those things already. He's not a market timer. The cash is really just a consequence of Berkshire producing a lot of cash and Buffett not being able to kind of deploy it anywhere. And also the repurchases over the last couple of years have been very substantial. He's bought back close to 10% of all the shares outstanding. So it's been really great that he's been able to put at least some capital to work through that repurchase avenue. And it's always cool to get a view of how Buffett actually thinks about Berkshire's business, and you know that we have this focus on kind of the four giants, and yes, there's a lot of other stuff going on at Berkshire, but it's really a lot smaller relative to those very substantial four businesses. So like I say, those are some of my highlights. I do hope you enjoyed this video. Let me know some of your highlights from this year's Berkshire letter from Warren Buffett down in the comment section below. Always keen to hear from you there. But that's it from me for this one, and I'll see you in the next video. Cheers.